Should you pay off your mortgage or invest the money? Ah, the age-old question that stumps even the savviest of financial enthusiasts. It's a quandary that no one-size-fits-all answer can solve, and that's because it's deeply personal. Your individual circumstances, financial goals, and risk tolerance play pivotal roles in tipping the scales one way or the other. Both options, paying off your mortgage early and investing your money, come with their own set of advantages and drawbacks. On one hand, paying off your mortgage can provide a sense of security and financial freedom. On the other hand, investing the money could potentially yield higher returns, setting you up for a more comfortable future. The key here is to weigh these options against your personal financial landscape. It's about making a choice that aligns with your long-term goals and your comfort level with risk. So let's dive into the specifics of each to help you make an informed decision. Scene script. First, let's explore the benefits of paying off your mortgage early. Imagine a life without the burden of a monthly mortgage payment. It's a dream for most, and it's completely achievable. One of the most significant advantages of paying off your mortgage early is the peace of mind that comes with being debt-free. You no longer have to worry about making that hefty payment every month. You're free from the financial obligation that ties up a significant portion of your monthly income. It's like a weight lifted off your shoulders, but it's not just about the emotional relief. The financial benefits are quite substantial as well. When you pay off your mortgage early, you essentially shorten the term of the loan. This means you're reducing the amount of interest you pay over the life of the loan. The savings can be quite significant. In fact, it could amount to tens of thousands of dollars, depending on the size of your mortgage and the interest rate. It's like putting money back into your own pocket. Let's not forget the steady increase in home equity. When you pay down your mortgage, you're building equity in your home. This means you own more of your property outright. It's a form of forced savings that can add up over time. And the beauty of it is, this money is yours to use as you wish. You can leverage it for future investments, use it for home improvements, or even use it as a safety net in case of financial emergencies. And if that's not enough, paying off your mortgage early can also improve your credit score. Lenders see you as less of a risk when you don't have a large debt hanging over your head. This could make it easier for you to get approved for other types of loans or credit in the future. As you can see, paying off a mortgage early can offer significant advantages. Scene script. However, paying off a mortgage early isn't without its drawbacks. Firstly, let's talk about the potential for higher returns from investing. When you choose to pay off your mortgage early, you might be missing out on the opportunity to earn more through investments. Historically, the stock market has shown to provide an average return that often outpaces the interest rate of a home mortgage. For instance, if your mortgage interest rate is around 3%, but you could potentially earn 7% from investing in the stock market, you'd be leaving money on the table by choosing to pay off your mortgage early. Next, there's the issue of liquidity. Paying off your mortgage early means tying up a significant chunk of your money in your home. While this isn't necessarily a problem if you have plenty of other cash reserves, it can become an issue if you face an unexpected expense or income loss. You can't easily take money out of your home without selling it or taking out a loan, both of which can be time-consuming and potentially costly processes. Finally, let's not forget the opportunity cost of using funds to pay off the mortgage instead of investing. Opportunity cost refers to the potential benefits an individual, investor, or business misses out on when choosing one alternative over another. By using your money to pay off your mortgage early, you're forgoing the chance to use those funds elsewhere. This could be anything from investing in stocks, bonds, or real estate to starting a business, or even just having a larger emergency fund. So let's sum it up. Paying off your mortgage early can lead to potential missed opportunities for higher returns from investing, a loss in liquidity as your money gets tied up in your home, and the opportunity cost of not being able to use those funds elsewhere. So, while freeing yourself from debt can be tempting, it's not always the most advantageous financial move. Now let's consider the benefits of investing the money instead. One of the most compelling reasons to invest is the potential for higher returns. When you pay off your mortgage early, the return on your money is effectively the interest rate on your mortgage. However, when you invest, your money has the potential to grow at a much higher rate. Over the long term, the stock market has historically returned an average of 7 to 9% annually, after adjusting for inflation. This could mean a significant increase in your wealth, compared to the savings from paying off a mortgage early. Another advantage of investing is the power of compound interest. Compound interest is the interest you earn on both your original money and on the interest you've already received. It's like a snowball effect. The amount of interest you earn each year grows along with your balance. Over time, this can result in exponential growth of your investment. Think of it as a tree sprouting branches upon branches, each one representing your growing wealth. Lastly, investing provides an opportunity to build wealth over time. Unlike paying off a mortgage early, which is a one-time event, investing is a continuous process. You have the flexibility to add or withdraw funds, adjust your investment strategy, and diversify your portfolio based on market conditions and your financial goals. This flexibility can be a powerful tool in building and managing your wealth. To sum up, investing can offer higher potential returns, the benefit of compound interest, and the opportunity to build wealth over time. It's important to remember, though, that investing also involves risk, and it's crucial to consider your own risk tolerance and financial situation before making a decision. Clearly, investing has the potential to significantly grow your wealth. But investing isn't free from risks. Let's dive into the less glamorous side of investing. As with any financial decision, there are potential pitfalls that could turn your money-making venture into a money-losing ordeal. First up, we have market volatility. The stock market is much like a roller coaster ride. There are ups and there are downs. While the long-term trend of the market is upward, there are periods, sometimes prolonged, of downturns. During these times, your investments can lose value, sometimes significantly. It's important to remember that investing in the stock market is not a get-rich-quick scheme. It requires patience and a long-term view. Next on the list is the potential for loss. This ties in with market volatility. While it's true that the stock market has historically returned an average of 7 to 8% per year, these are average returns. Some years the return can be much higher, but in others, it can be negative. If you need to withdraw your money during a down year, you could end up with less than you initially invested. That's why it's always wise to have an emergency fund set aside, and to only invest money that you can afford to potentially lose. Lastly, successful investing requires a certain level of financial knowledge and discipline. You need to understand the basics of investing, such as the difference between stocks and bonds, how to diversify your portfolio, and the impact of fees on your returns. Without this knowledge, you could make costly mistakes. Discipline is also key. The temptation to sell when the market is down, or to jump on the latest hot stock can be strong, but these are often the actions that lead to poor investment outcomes. While investing can be lucrative, it's important to be aware of the risks involved. So before you decide to invest your money instead of paying off your mortgage, consider these potential downsides. Remember, every financial decision comes with its own set of pros and cons. Your job is to weigh them and decide which path is right for you. So, should you pay off your mortgage or invest the money? It's a question that warrants consideration. In our discussion, we've explored the two sides of the coin. Paying off a mortgage early can offer peace of mind, the freedom of owning your home outright, and the potential for significant interest savings. However, it also ties up a substantial amount of your capital in a non-liquid asset, and may limit your financial flexibility. On the other hand, investing the money could yield higher returns in the long run, provide more liquidity, and offer tax advantages. But it's not without its risks, as market volatility can impact your investments, and the returns are not guaranteed. The answer to this question is not a one-size-fits-all. It's a choice that hinges on your individual circumstances, risk tolerance, and financial goals. In the end, the choice between paying off a mortgage early and investing the money is a personal one. Consider your own financial situation, goals, and comfort level with risk before making a decision.